few minutes. Hi, everybody. We're running a few minutes behind, but thank you all for joining us today. First of all, it's Thursday. I'd like to put a date on this, since as this goes up, we may not know when this took place. So this is Thursday, May 21st. And as you folks know, I'm Tony Bartos with the Newport Beach Association of Realtors. And I just wanted to really kind of thank our members, first of all, for joining us today. This is another installment of a series that we've been doing. We call it the Revelatory series, where we try to kind of bring political and industry leaders to talk about the issues that are impacting realtors from the coronavirus shutdown. And just for example, in the last month, it's been my pleasure to interview California State Senator John Moorlach regarding the state's response to coronavirus. Last week, we had Chairwoman Michelle Steele of the Orange County Board of Supervisors regarding the specific county-wide issues. And earlier this week, we had the great pleasure of featuring Dr. Lawrence Yun, the chief economist for the National Association of Realtors, and that was a real interesting discussion as well. Well, today's topic is what happened to jumbo loans. And as we all know, many realtors have been out of work for a couple of months, and so you don't realize that many don't realize, in fact, that the landscape for financing jumbo loans in particular has changed greatly in the last 60 days. And so the topics we're going to cover today are basically what happened to jumbo loans. They're a lot difficult to find. Talk about maybe some of the lending changes and maybe what to expect going forward, and also loss mitigation elements. And so today we have JP Morgan Chase, some executives from JP Morgan Chase on the Zoom call with us. And I'm so happy, and I want to introduce first I want to introduce Ann Sugai. Ann, can you hear us? I know you're just joining. Are you able to hear us right now?
I got over my technical difficulties. Can everyone hear me?
Well, excellent. Well, Ann is the managing director for home loans in California. Is that correct?
Yes.
Did I butcher your title there?
No.
And then also we have with us Erik Schmitt. Erik Schmitt is the national product executive for Chase, and along with Erik, thank you for joining us today.
Thank you.
All the way from New York City. I know it's a little bit later from you. And then also Jeff Fisher, executive director for loan originations, and Ryan, who's the VP for this area. And why don't we start off here? I know I did kind of a brief introduction of your team, but maybe give a little more introduction as to kind of everybody's role in our discussion here today.
Oh, sure. So, I have the pleasure of running the California market for Chase. So you think about all those bank branches. We have about 1,000 of them in California. Unfortunately, I don't have loan officers in every one of those branches, but in the vast majority, I have loan officers in there serving our communities, doing anything from the first-time home buyer all the way up through the jumbo lending, 10 million up to 10 million in our division. And then Erik Schmitt, who runs our national platform for products and innovation. He's been with the firm for a very long time. He works a lot with the agencies as well, and as well as with the credit risk team. He has a really big role today. Like when you think about all the innovation pieces, all the digital platforms that are coming on, all the different ways that our customers want to engage getting a mortgage, as well as the new products. Erik's got like a huge, big role, but I thought he'd be so appropriate to bring here today because there's just a lot going on, like you started with, Tony. There's just so much going on in the industry, and I think that Erik can give a little bit of background, especially when this COVID hit, like in mid-March, sort of like really what happened to liquidity, what happened behind the scenes with some of these jumbo lenders and their ability to sustain themselves, as well as sort of what is life going forward. We'll talk a little bit also about forbearance. That's a big topic for our customers and really helping them in a time of need, and certainly want to afford them the ability to have a pause regroup, get them back on their feet so they're able to make their mortgage. And then we have Jeff Fisher, and Jeff Fisher runs parts of LA and all of the Orange County market for me on our team in the origination space, and he's on the call. And then Ryan Cison is very local to everyone's market, where he has the Newport Beach and Huntington Beach area, and he has a team directly with the what we call home loan advisors, meaning loan officers, and he manages a team of about 22 people out in the Huntington, Newport Beach area. So thank you, Tony and Kimberly, for having us today. We're super excited to be able to help and talk and answer kind of questions that you guys have.
Well, we are excited to have you. And so one of the reasons, one of the reasons that I wanted to have you on is this whole issue of jumbo loans. I have a lot of friends who are mortgage brokers who had, wholesale lines or correspondent lines, and all of a sudden, in a matter of like a week, their ability to do jumbo loans disappeared. And so I figured since Chase is a big player in the jumbo financing market, what happened? What kind of give us an overview of either Erik or Ann, like what occurred that put us in this position that we're in now, just for people that may not understand what exactly occurred.
Sure. And I think it was primarily confluence events that kind of driven some of the challenges for liquidity. So when you step back in March and April timeframe, as servicers and customer needed relief, many customers went into forbearance. And if they went into forbearance on a new origination, which on a warehouse line, there was uncertainty of whether that loan was liquid, meaning it could be sold either to the GSE or the end investor or correspondent, another aggregator of jumbo loans. And because of the concern about liquidity, there were haircuts placed on loans, which means the amount of financing for every dollar of UPB went down as the risk of the loan increases due to non-performance. So historically in the jumbo spaces, the loans are very high quality. There's very little defaults. Therefore, this circumstance never came up where you'd have a lot of loans that were non-performing technically on a warehouse line. And because of that, the cash demands increased as the margin call existed. This also happened at a time where in the secondary market between March and April, there were significant hedge losses on positions due to volatilities in the market at a time where we had very high volume, so you're paying out cash and the commissions, which are also constraining this, and at a time where servicers would begin to make advances on mortgages. So when a customer enters a forbearance plan, generally speaking, the servicer makes the advances to the investors and then recoups that later in the process. So the cash demands on originators, especially small originators, was very significant at a point in time that it all hit them at once.
So let's take a step backwards if we can. So you have basically two types of, you have these agency loans, right, that Fannie Mae, Freddie Mac are purchasing, and those are available. And then you have the jumbo loan products. Now, walk us through like kind of a brief overview of the mechanics of how does that market work? Because you hear things about lenders keeping a loan as a portfolio product, or whether they're selling that loan off into the secondary market. Which component of how those mechanics work broke in this process?
Sure. So effectively, there's challenges on both sides, the GSE and then the jumbo side. So on the GSEs, there's uncertainty for a period of time whether a loan that was in a forbearance was deliverable, meaning that you could sell it into a Fannie or Freddie Mac security or not. A few weeks ago, they issued guidance that basically said you can sell it to us if it's performing. However, we're going to charge 700 basis points or 7% on the UPB as a fee for that risk, or 500 basis points if the loan was a first-time home buyer. If the loan was cash out, they will not purchase it still today. So that created liquidity. What we've seen in the recent environment is there's a more robust market developing for those loans that are non-saleable to the agency. On the jumbo side, there was not an agency, so it was kind of correspondent lender or originator like Chase making decision by decision. Also, at the same time in jumbo, very large institutions, some of our bank peers have pulled out of the correspondent space. Chase is still a large correspondent lender for both agency and jumbo. We have not retreated from that space. Also, some of the large aggregators that were securitizing, the securitization market, right, was not as liquid because of COVID and the uncertainty about risk performance. So some of them started stepping back. So what you saw is those that use securitization as the exit for jumbo were no longer buying loans. A large, competitor of ours also stopped buying loans in the correspondent market, and then we were continuing to buy loans, and we have a very large market share today in the correspondent space. So I think that's what happened. We haven't seen the jumbo market return yet. I believe as we've seen nationally, we've seen forbearance rates decline. So hopefully that will help reduce some of the risk. Additionally, the GSEs as well as jumbo lenders have instituted new policies to shorten the time frame for employment and income verification between the closing of the loan and that time period to ensure they're accounting and making sure we're creating sustainable and affordable homes for customers. So that may also reduce some of the forbearance entry. Once that market has stabilized, I believe there will be a return to liquidity for the jumbo market.
Okay, so what I'm kind of hearing from you is that this COVID crisis caused a lot of people to request some type of loan forbearance. And maybe, Ann, you can kind of explain what is, for people that don't know, we're in Newport Beach. A lot of people have never, unless they were in the business back in 2007, maybe may not even understand what a loan forbearance is. So why don't you give us an explanation as to what that is, since that seems to be the crux of part of the problem here.
Sure, no, absolutely. So, when this COVID started in mid-March, we obviously understood that there were lots of folks that were going to be unemployed, right? And you've seen, if you've read any type of news media, right, that our unemployment is quite high. And in certain areas, obviously, it's been hit harder than others. But nationally, we've come out and said, listen, if you are having trouble making your mortgage, then there's a 90-day period in which will allow you to forego making a mortgage payment. Now, every lender after that are treating things a little bit differently. We've come out nationally and said this is not going to hurt your credit score, but it's a way in which to give you a breather in case you need it, in case that you are unemployed or you have some kind of an unforeseen circumstance during this whole pandemic that gives you some relief. You go to your lender, you follow the rules appropriately through their website or calling, and ask them, that, hey, I'm in need of trouble, or I can't make my mortgage payment. They're going to make arrangements for the next 90 days to help you until hopefully, we can get back on your feet, get back employed, and start making your mortgage payment. Because we understand that there are millions of customers, right, that became unemployed and might be in need of some help.
Okay, thank you for that. And so regarding that forbearance, I've heard things of different lenders handling that differently. For example, whether there's a balloon payment due at the end of the forbearance period, are the payments that you didn't make rolled into the back end of the loan? Like, give me even with Chase, or how you understand maybe other lenders also deal with that issue.
Yeah, I would definitely say that I can't speak for all lenders. There are different types of ways in which they're making up those payments. We are asking that at the 90-day mark, if customers are not able to continue to make their payments or are going to make their payments, they do need to call in and start making arrangements for whatever is appropriate. But all the lenders are performing differently. Erik, is there anything else different that you want to add to that?
Yeah, sure. So, obviously it's generally driven by the investor as opposed to the servicer. So generally Fannie and Freddie have a policy, FHA, and Rural Housing has a policy. And then for portfolio lenders, they have their own policy. But generally what servicers are entering for government insured or guaranteed or backed mortgages is that you can extend the forbearance up to a full year. You must engage with your servicer, engage in much of that is protected under the CARES Act as well. So you can extend the period of time where you're not making payments and credit bureau reports up to a year if you continue to engage with your servicer and request assistance. When you're ready to reestablish, it's generally a waterfall, which is investor dependent, but the way it is, the first question is, can the customer reinstate the account, make up their missed payments? If they cannot do that, then the question is, can they do a repayment plan? Generally speaking, the waterfall is where they have the ability to make a slightly higher payment to catch up on that delinquency. Additionally, there's products like the GSE deferment where they basically take the payments and it's a balloon at the end. And then lastly, the GSEs and others have traditional loss mitigation products for customers who can no longer get to their old payment for a permanent hardship. And there's things like the GSE Flex Mod and other loss mitigation tools that allow for a lower payment. So there's a waterfall of solutions that are basically with the servicer or work with the customer to understand their hardship and their ability to return the payments. And based on their financial situation at the point of ability to return or they're over the COVID hardship, they'll find a solution to work with that customer. Generally, one of those 4 products will be available.
Well, that's really encouraging if you're a borrower who needs help to know that there's a kind of a range of options. So, to reach out to your lender to kind of see what those are if you need help. So going back to kind of the secondary market and jumbo loans, how has this COVID crisis kind of changed underwriting criteria, the types of loans? I'm just thinking in terms of agents who haven't been working in the last 2 months, coming back to work and getting back into the market over the next couple of months. What do we need to know now that we didn't need to know 3 months ago in terms of the lending environment for, let's say, for jumbo financing or any financing for that matter, if it's changed on the agency products as well?
Yes, so Tony, that's a great question. The agency, Fannie Mae and Freddie Mac, have made some, cutbacks on maybe their FICO score, their loan to value, on some of their products, as well as the jumbo lending has also had some temporary guidelines. The 2 products at Chase that we haven't touched, right, is our first time homebuyer Dream Maker product where you can put 3% down payment. That we still want to go out and very strongly promote, for folks that we've always had this loan down payment product, but we certainly want to be advocates for it today. If you're a Chase if you're just trying to refinance your own Chase mortgage with us, right, we have some normal guidelines for you as well. But certainly these guideline changes, Fannie Mae and Freddie Mac and the jumbo lending in general are deemed to be temporary in nature, right? So we don't know exactly when some of these restrictions will be lifted, but Tony, I assure you that if you talk to any major bank, they're still refinancing lots of customers because there are still lots of customers, they're able to make their mortgage payment. We're still also in the purchase market, right? Many of the lenders are still doing purchase transactions. They're just a little bit less of them, it feels like, out there in the market. But I know in Chase's position, we're ready to take on, purchase transactions. We have a full operations that's all working remotely. So all of us are working remotely today, as many of you are as well. We still have our purchase guarantee closing guarantee that we've offered out in the community, and that's a fairly wide known. If we don't close you within a 3-week time frame, we give you $1,000. And so, but we do have some restricted guidelines, right? As most jumbo lenders have in the market.
So I've heard other products are impacted by certain lenders. I don't know if you guys are impacted by this. For example, I've heard about HELOCs being, credit lines being cut for borrowers. Is that something that's occurring with just some lenders, or is that something that you're seeing industry-wide? Just curious as to what the impact of other lending products from this crisis, other than just purchase and refinance.
Yeah, so
business.
I would say, Tony, like when you think about 2008, if for those of you that were actually in the industry, as I recall, not only did some lenders, stop doing HELOCs, but they also froze their credit lines. I don't know if any of you remember that, but I do recall some of that going on.
Absolutely.
I would say that, right now we are putting a pause on our home equity line of credit products at the moment. But again, it's a simple temporary measure that we're trying to put in place until, we can see that, things have changed around the nation as far as economically. So we're putting a pause on HELOCs. I actually can't, speak for the rest of the big banks and what they're doing, but we did put a pause on that temporarily for us.
Well, that leads me to kind of another question, because I hear both you and Erik saying, these are kind of temporary measures. What, I guess the question for either of you is, if I'm talking to a borrower or a friend of mine, friends who have owned mortgage companies, it's like, what do you think the banking industry or lending industry needs to see before things return to some sense of normalcy, before mortgage brokers start getting those correspondent lines back, and some of these kind of restrictions start normalizing, I guess, for lack of a better clumsy way to say that.
Right.
Sure.
Well,
So,
yeah.
No?
I'll just speak from the origination side, Tony, because that's obviously, my specialty is, we're lending 80% financing with a 700 FICO score for most single family units, on the jumbo side, as well as the agency side. So by no means, and then, like I said, we still have our first time home buyer, our Dream Maker product. So in no means is that a scary FICO score to most people have 700 FICO scores, right? Most people can, there's a lot of customers that can put 20% down in this environment. So the best thing to do, if anybody has, any questions, now would be the best time more than ever to go into an institution and get pre-qualified, right? Talk to your loan officer and talk to them about their qualifications. Get a pre-screening done, get their credit checked, get their whole scenario checked, because each bank's different and they're the most experts to know what the current guidelines are, and all the lenders are doing things a little bit differently. Some of the things that are really making things easier, though, knowing that we have this shelter in place, is we're doing a lot of drive-by appraisals. So we're not asking to get into the interior of the home. So think about a purchase. There's lots of transactions that we're doing today that we simply don't need, an interior appraisal. So, we're trying to make things easy as possible. We can, obviously do some conditional pre-approvals up front for customers, as most large lenders can do that. That gives the customer some safety that they know that they've been checked, from a credit qualifying. Erik, what do you have to add on that?
Yes, so I would say, like, even within a temporary, a tighter credit box, we still can service a majority of our customer base as we did before. So again, said for jumbo, we're still going up to 80 LTV, so under FICO, which is the vast majority of our historical business for purchase, especially. We're fully committed, as we always been, for our key flagship product called Dream Maker, which goes up to 97 LTV at a 640 FICO and 95 at 620 FICO. So we're really committed to providing customer liquidity for first-time home buyers is a great product for, an ability for, low to moderate income customers to avail access to credit. As Ann said, we're still offering, if you have existing Chase mortgage, we have not changed any of our agency guidelines for Chase refinances. So we want to make sure those customers can take advantage of current rates if you're an existing Chase mortgage customer. So, and in correspondent, we're still purchasing both agency and jumbo loans at similar, risk criteria in the correspondent space. So we're very active and, open for business for there. The other piece that we've done as an industry is we have a critical responsibility to make sure we place customers in affordable and sustainable mortgages. So a lot of the changes have been more around verifying employment and additional checks closer to closing, because we've seen abnormal levels of unemployment, which is horrible for the country, but creates a lot of volatility in the customer scenarios. So we're kind of doing a little more double checking prior to close to make sure we're placing customers in sustainable loans. So I think those will, moderate once we get through this wave of unemployment and we see normalization in those levels.
One of the members in the chat asked, kind of just to shift back to the HELOCs, wanted to know that as far as freezing credit lines or not funding those, or is that for just existing HELOCs, or is it for just restrictions on new originations for HELOCs?
Yeah, so Tony, we're not, I was saying as an example, back in 2008, they were freezing, credit lines. We're not at that, Chase is not at that place. We have put a pause on our HELOCs of originating new ones. But, we're allowing any of our customers that have home equity line of credits right now to freely use those. There's no restriction on them. But we have put on, during this temporary credit box changes, we have temporarily put a pause on that home equity line of credit product.
Okay.
Yeah.
Going back to something I think that Erik was mentioning, talking about your correspondent lending lines and such, what friends of mine who own mortgage companies have talked about, all the different banks that they had, lines with that just either that disappeared, in the matter of 2 weeks, went out of business or they lost their lines. Are you guys in that position of looking to expand that correspondent lending side of your business?
Yes, I mean, we have over 600 correspondents, which we purchased from. We're continuing to look to purchase jumbo originations through a channel as well as GSE originations. So we're fully open for business there, and the volume is very low industry wide, right? Because it's very cash intensive for those smaller originators. Even with availability warehouse lines, it's still a very restricted cash restriction business. So we're fully open. We're doing business with over 600 clients. We're really committed to that space.
So that's great to hear, and I'm sure there's probably a mortgage broker listening somewhere who's probably like, how do I get a correspondent line with Chase, especially for these larger loans? As we kind of talk about this, the one thing that I haven't mentioned is kind of the federal government in all of this. I mean, what has the Fed's role been in trying to, if any, in trying to kind of work us through this crisis on the lending side? Is there any role for them to play on the jumbo loan side, or are they mainly just in that agency Fannie Mae, Freddie Mac space?
Erik, you want to take that one?
Yes, I think the primary influence to date has really been on FHA, VA, rural housing, and then Fannie and Freddie lending, right? Where there's a coordinated effort to try to align, especially between Fannie and Freddie, on loss mitigation solutions, on changes to criteria. So as we as industry evolve, they're very coordinated, and when they change a policy, they both change. So it's one change for lenders to absorb. So it's been very coordinated and well absorbed. I think the entire industry, including the federal government, has done an excellent job of making sure customers who are impacted by the pandemic have available options that don't impact their credit, and then have long-term solutions for those who need longer-term solutions. So I think we're in a really good place. What we learned from the crisis has carried over, and the immediate action the federal government, as well as large guarantors and insurers of loans, did was, let's make sure we have the framework set up to help those customers who are impacted. And now it's moved to the focus on origination side. How do we ensure we're creating sustainable and affordable house ownership, and then liquidity in the market? So the federal government, as well as the various regulators, as well as Fannie, Freddie, FHA, VA, have all done a great job of coordinating that effort and making sure there's liquidity for customers. Any
idea when market liquidity on that lending side is going to come back? I know you mentioned that JP Morgan Chase is a buyer of some mortgage products. What about everybody else? Any time frame on when that whole market's going to come back, so that there's obviously an expanded pool of available funds to pull from?
It's really hard to predict. I think we're seeing some positive signs in the national levels. Customers asking for assistance has kind of appeared recently to stabilize a little bit more. Hopefully, the unemployment numbers continue to go down. The ongoing unemployment is reduced. As some of the stay-at-home orders relax, hopefully economies get back going. Our customers and citizens are able to work again. But until we kind of see those events, it's really hard to predict when exactly that will occur. But obviously, like Ann said, we're committed both to fully to purchase space. We offer 700 plus FICO, 80 LTV, and for for low to moderate income customers, we have a great product called Dreammaker that's really focused on up to 97% financing down to a 640 FICO. So it's a really, really great product, and we're really committed to that space.
Well, great. Well, thank you for that. So kind of moving on to, and by the way, I wanted to, at this point, just invite any of the members who have questions that you want to pop into the Q&A or the chat box. This would be a good time to do that. But I wanted to talk a little bit about the future outlook, which we've touched on a little bit. I know, and this isn't specific to Chase, but I'll use you guys as an example. It was reported in April that Chase, along with a lot of other lenders, public lenders, reported big profit declines as well as increasing their reserves. I think Chase mentioned they raised their reserves by like $7 billion or so. What does that suggest kind of moving forward? And I know you have to be kind of sensitive about, not making any, it's a public company, you don't want to make any statements specific to Chase because we're not asking for Chase's specific outlook, but I am asking like industry wide, is this a precursor to a wave of foreclosures, or is this just done in anticipation of all the forbearance stuff that's going on? I'm just kind of thinking 6 months out, are we likely to see a problem moving forward?
So what I can speak to is, what I would say is what we developed in the crisis, and I closely worked, with MBA on a product called OneMod, and Chase has spent a lot of time and energy focusing on industry-wide how to prevent foreclosures. So I think we have such great tools in place that we developed during the crisis and developed during COVID that I don't believe we'll see a wave of foreclosures because we have such great tools to help customers. The other main difference is the crisis was created in some part due to unsustainable or unaffordable mortgages. Post-crisis, all these customers were fully underwritten, generally speaking. They could afford their mortgages, and they were in really good financial positions when the loan closed. Now they've been impacted by a pandemic. Hopefully they can return to a very close to where they were before the pandemic. So I expect the impact to be much less than the crisis, which was somewhat created by unaffordable mortgages. I think that's a really good tailwind, and all the great products we develop, I think, will simply prevent foreclosures. And everyone's very committed to that space. Both servicers, investors, guarantors, of constantly designing and innovating in this space to make sure we keep customers in their homes.
So you're basically saying the mortgage space, in terms of borrower criteria, loans made, is very different now through this pandemic than it was in 2007, 8, 9, 10. During that period, you're in a much different position, not only to deal with the defaulting, the troubled borrowers, but also in terms of just the products that you're offering.
Yes, I mean, the exotic products, are gone. The customers who are on stated loans or no income verification loans are all gone post-crisis, right? All loans are fully documented. The decision engines are much better now, and risk management is significantly better now on the origination side. So we have a really good, strong credit profile of customers coming in to the pandemic. And the pandemic, obviously, hopefully it's temporary in nature and customers can get back. But the good news is, as an industry, because of the crisis, we have really, really good tools to help customers who are facing hardship to resolve those hardship and avoid foreclosure. So I think all the lessons we learned in the crisis have allowed us to establish a very robust set of frameworks to help distressed customers and find the right solution to help that customer cure their hardship.
And do you think, is that a Chase thing, or is that just kind of an industry-wide thing that the industry as a whole, when you look at all the larger banks, are better prepared?
I would say large bank, independent mortgage banks, everyone, all servicers generally utilize very similar tool sets, which for Fannie and Freddie are nearly identical. FHA and VA and USDA have also made a lot of changes to their programs. So I feel really good industry-wide that we have the right tools to help customers, and those tools are generally dictated by investors. So, obviously large financial institutions, Chase was wholly committed to helping distressed customers, but I think industry-wide the tools are very advantageous to customers as well.
You just reminded me of a question that I had, kind of a mechanical question in a sense of, as a servicer, so you guys service loans, a lot of banks service loans, but they aren't necessarily, are they all loans that you originate, or they're loans also from other investors, I assume?
Yes.
Okay. So when somebody stops paying their mortgage and they go into forbearance, are you, as the servicer, still obligated to continue to pay the return on that loan to that investor?
Yes, depending on the security, generally speaking, we advance interest, and sometimes we advance principal. Additionally, depending on the level of delinquency, we may also advance taxes, insurance, depending on the time of the year and where the customer is in their escrow. We'll also advance tax and insurance for the customer. So that's part of what I was speaking before. As delinquency rises, it's required a lot of cash from servicers to make those advances.
I see, because even though the servicer isn't getting paid the mortgage payments, you still have to pay the investor as if you were getting those payments.
That's correct. Yes, it's called advancing. We advance them on behalf of the customer to the trust, and then eventually, for most programs, the guarantor or insurer will reimburse the servicer. If the portfolio owns a loan, then it's obviously we would be exposed to that credit risk.
Okay, interesting. So one of the I think I know the answer to this question, but maybe just on a more industry-wide basis, somebody asked, is there any update on bank statement loans coming back at any point soon, or loans for individual business owners?
Yeah, I mean, for loans for self-employed customers, we're definitely still, doing them, Tony. I think the difference is that we are asking for, more recent and updated documentation. Naturally, like when you just think about the time frame being, mid-March to now, right? We're a little over, 90 days or so into it. And so all we're doing is asking for updated information from the customers. So on self-employed customers, we want more of an updated P&L statement to see, how is their revenue being affected, positive or negatively? What are their assets, updated assets look like? And then, just looking at their cash flow, right? So a lot of the lenders, and this is not out of the ordinary, are going to look a little bit more carefully in the last 90 days. How's your cash flow been for a self-employed customer? But that doesn't mean by any means that we're not lending to them, because we absolutely are within Chase, and I would say industry-wide. But some lenders might be requiring a little bit more documentation today, just to get a more updated picture on their financial state and how they're faring through some of the issues that we've had.
As we kind of near the end of this, one question that came up when I was interviewing Lawrence Young, the chief economist for the National Association of Realtors, on Monday, was he had mentioned that there's a disparity between treasury yields and mortgage rates, that the rates seem to be, at least in his view, higher than you would expect them to be. And so I just wanted to know if you had any comments related to that. I mean, do you guys foresee rates potentially dropping as we kind of get through this crisis, given that disparity between yields and mortgage rates?
Erik, you want to take that? Or I think Tony, it's one of those things that's very hard to predict. As far as, I think it's right now we are afforded some really low interest rates, and they don't naturally follow the Treasury. So I do understand, what he's talking about. But maybe Erik, you have, some other more details to give over.
Yeah, the other thing I would just say, I think that's true. I think the other thing that are also possibly true is that, because like Ann said, there's a lot more cost to originate a loan these days, because you're doing a lot more diligence in regenerating the loan. Additionally, there's more credit risk likely in this environment than may have been priced in, previously, because of the fact that, for example, I mentioned before, if a loan goes in forbearance before we deliver to the GSEs, we have to pay 5 or 7 points, right? So some of that's going to be, eventually absorbed into the pricing. And then the MSR cost, as we talked about, when loans go into forbearance, the servicers must make advances. So that cost is also getting embedded into the valuation of the servicing, which is not, does not necessarily correlate with the Treasury yield. So I think the costs are going up in the interim, as we, do additional diligence to account for, unprecedented levels of unemployment and instability that's very hard to historically model. I think that may be some of the increase you're seeing in differential between mortgage yields and Treasury yields.
Okay, well, by the way, thank you for that explanation. Well, I really appreciate all the information that you have all provided. And Kimberly, do we have any other? I just wanted to see. I've gone through several of the questions that were in the chat. Do we have any others that are pending at all?
No, but you're welcome to entertain questions, and they can raise their hands if they'd like.
Yeah. Okay. Yeah. If anybody's got a question, we can kind of field it to our guests. And yeah, it's kind of an interesting. I hope it's not too granular for some of the people that are watching. It's what I'm basically hearing from you is, hey, we've had to make some big changes as a result of COVID. This COVID crisis isn't the 2007-8 crisis, and we're all hoping it's, including yourselves, hoping that it's going to be short term in nature. And that's kind of encouraging. It kind of goes along with, by the way, what Dr. Yun said to us on Monday as well, which was very kind of optimistic. One of the panelists is just curious, Anne, you might know this, or one of your other gentlemen. What is the current 10-year fixed for a jumbo purchase for Chase? That's what somebody asked. What is the current 10-year fixed on jumbo purchases for Chase?
10-year, we have a 10-year fixed that rolls into an ARM after that. I don't know if Jeff, or I wouldn't want to. You
don't want to quote a rate, yeah, but you don't have the sheet right in front of you.
But Tony, like Ryan's on right now, he can give you some generals, but like I would really welcome the opportunity. You know, one of the things that we got Ryan on is because he's a local presence in the market. We're all working virtually, every day. And so he's a great resource to check in really, right? But I don't know, Ryan, can you hear them? Maybe you can say hello.
Yeah. Can you hear me?
Yeah, absolutely.
Yeah. Just like with any rate quote, it's going to vary. Is it a, loan to value ratio, FICO score? There's a lot of elements that go into a rate quote. What I can tell you is our pricing is quite strong. I just hesitate to put anything specifically out there without, really getting the nuts and bolts of it. So I'm happy to answer that question offline if they want to contact me directly.
Okay, fair enough. So one of the other questions that's asked in the chat window is, what is your position on refinancing or pulling out equity from a non-owner occupied property in order to get cash for a down payment on a new purchase?
Yeah, I would definitely say, so if I heard you correctly, Tony, we're talking about a cash out transaction on an investment property to then go and purchase a primary.
Right, to use that cash out to purchase.
Right. I will speak for Chase. Right now, we do have some restrictions on the cash out on investment properties. Naturally, we're looking cautiously at some of the investment properties in general, right? Because they do carry more risk. I think that would be a very fair statement to say. So temporarily we're not doing cash out transactions on investment properties. But obviously happy to talk to any of the customers out there that are inquiring.
Do you know, is that common to some of the other larger banks as well? Not that I expect you to know what Wells and B of A and others are doing, but is that kind of something that we're kind of seeing consistently?
Yeah, I would just say that, lender to lender, Tony, that would definitely vary. There's always, different institutions out there that have slightly different criteria. I think right now what we're really focused on is, really wanting to help customers purchase homes at the moment, right? For primary residences, we're doing second homes very well. We're taking a little bit of more of a pause on the investment properties, but we're really out there to help, because listen, there's all different types of scenarios. There's customers that are in need of purchasing homes right now, but we have a full lending, spectrum of a conforming product, a first-time home product, up to that jumbo lending product that we're able to serve. And we feel strongly that we're covering the vast majority, right, of the customer base right now, and really trying to serve them in this time of a temporary setback on our guidelines.
Great. Well, thank you for that. As we kind of wrap up, I've asked a lot of questions here, but I just kind of like to ask you, and if there was anything that we haven't addressed in terms of that, if you were in our position, if you were a realtor working in the field, and you said, hey, you know what, I wish you would have asked me that question. Is there anything that you feel we ought to know about the lending environment that we haven't already discussed here?
I'll take that. I mean, I think that knowledge is power. And I think that the customers today, need to be consulting with a lender for mortgage advice when venturing into, purchasing a new home. It's really prudent right now to find out what's out there, what are the products out there, how do they qualify to be the most prepared. And we feel confident that, we are serving so many customers right now, Tony, that there's a lot of customers that can buy houses right now, right? And so we want to make sure that we can help and serve that community, but make sure that we're managing the customer's expectations accordingly. So I think right now more than ever, it's important for the real estate agents to be partnering with a lender, and to make sure that they fully understand what credit criteria they have, and making sure that the customers are getting connected with the lenders. And we're helping our customers that don't have real estate agents, by the way, get connected with the real estate agents that we have contacts in, so that we can help each other, as we move through this environment.
Hey, great. One last thing. I know, Jeff, since you kind of handle this LA region, specifically LA and Orange County, are there any are there any peculiarities to our market here specifically that that you think are unique to us that, as agents we need to know about?
Yeah, and thanks, Tony. I mean, I think every market's got their own unique attributes, right? And I think the one thing that makes Orange County and definitely parts of LA kind of what they are is the full breadth of the products and programs and properties and customer base and demographics that we get to take part in. And I think everybody, especially the ones that are part of the Newport board or engage with the Newport board, I mean, we see everything, right? I mean, nothing surprises us on any given day. And I think, having the understanding and the wherewithal to ask the questions, and going back to what Ann was saying, I think as I'm interviewing agents regularly and having conversations with the real estate community on a regular basis, I'm constantly coming across, and I'm going to call them misnomers. I heard this, or I'm not doing this because, somebody told me that. And really it's, each one of the lenders in today's environment is completely autonomous. We're all dealing with the same thing, and how we approach things is unique and different as well. But you have to stop and ask the question. I guess what I'm trying to say is, in every situation, talk to somebody, have that established relationship with somebody that you trust, and be able to ask those questions, because there's just a lot of just misinformation that's flowing around out there. And we're doing our best to keep in front of everything especially with our dedicated teams and our agents that we work with. But we can't be there all the time. So pick up the phone and call us, or talk to Ryan or I, and we'll make sure you get connected with somebody you can trust and build upon.
Hey, Tony,
All right. Yes.
This is Ryan. I just wanted to add a couple things that we're seeing on the local level, specifically in Orange County. And I saw some interesting data today. And Kim and I were talking about this earlier before we started the call, but as of the past 60 days, we've had 3,400 closed transactions in the past 60 days in Orange County. On top of that, we have about 1,800 deals in escrow. So if we do the math, right, 2 sides to every transaction, that's 10,000 transactions or households that are doing business in Orange County. So I thought that was interesting for the agents on this call to hear as well. All you guys have access to all this data as well. But the eye-opening thing for me is that a lot of the inquiries we're getting today and the increased activity on clients looking to get pre-approved or pre-qualified is for 2 reasons. Number one, people need space. They need a room to take a Zoom call in instead of a closet, or wherever it is they're hiding from their kids. And secondarily, the kids aren't in school, so moving is not a problem right now. So really those 2 motivating factors we're seeing a lot on the front lines, and I think it was important to share, especially for all the agents on the call, because the business is out there and we're happy to help you with it.
Yeah, I noticed that myself. For some folks, like I'm very busy right now, and have been through the entire crisis, and some are and some aren't. But we've had some kind of encouraging information over the last week here, with you folks on this call, and then also with Dr. Yun on Monday. So as we kind of wrap up, I just want to, first of all, thank all of you for your time. Thank you, Ann. Thank you, Erik. I know being in New York City, you're a bit ahead of us, and so I appreciate you being on this. And Jeff and Ryan, so grateful to have you guys here too. And I think it's been very informative, and I hope the members have enjoyed it. And perhaps we can do it again at another time. But thank you for joining us, and thank you, Ann, so much. Ann, if there's anything you want to close us out with, I'll give you the 20 seconds to do that now.
Sure.
Before we sign off.
Sure. No, I mean, it was a pleasure to get on. And I think that one of the things that I've talked to the California team a lot about is, Tony, is just educating the real estate agents and educating our clients, right? And understanding that there's a lot of lenders that are still lending. All is not gone, right? We still, when you mention about what Ryan just talked about, just in your own community, there's a lot of activity, and there's still a lot of people that are employed, engaged, and able to qualify for mortgages. So we're very optimistic. We have the full capability, and as do a lot of these lenders, we're still lending, right? And yes, there's some modifications, but it's a very, we're very optimistic about the market. We're very optimistic about our product set, and the fact that we might have some temporary guidelines that are a little bit less restrictive. But the one thing, and I've been with Chase for a very long time, is that we're a very common sense lender. We want to do the right thing, not only for the customers that are having trouble making their mortgage payments, but also trying to get everybody possible into a home safely, and also without putting them in any kind of harm's way financially, right? So that's kind of our goal. But we appreciate your time today. And we appreciate, I would highly encourage you to get a hold of Ryan. He's one of our best lending managers out here in my state of California. He's a sharpshooter. And Jeff also does a fantastic job running the LA and Orange County market. And our very special guest, Erik, thank you very much, because he, as you can tell from his technical knowledge, is just a huge asset to us. We count on him each and every day to help us make some decisions. But Tony and Kimberly, thank you so much for today. Really appreciate it.
Well, thank you guys very much. Thank you for the time. We're at just about an hour here, and it's been my pleasure. Thanks again.
Thank you.
Thank you.
All right. Thank you.